Welcome back to the Asian Investment Conference, where the future of Europe is of course a key topic on the agenda. Just out of a panel discussion on the region's path forward, and joining us now is Wolfgang Munchau, European economic columnist at the Financial Times. Wolfgang, last November you said that European leaders had 10 days to save the euro. Is the euro safe?
The euro is not safe. Well, the euro still exists. It won't. I don't think it will collapse as a currency. But what they didn't do is to create a structure then that would allow the Eurozone to keep together in unity. There's still a certain probability that Greece might leave, and there's a certain probability that the crisis will continue. Even though the situation is much better now, there is a probability that that there's contagion to Portugal and to Spain in the not too distant future.
The markets seem to believe the worst is over. Are they too optimistic?
Well, the markets have been very volatile during the crisis. I think they are. The markets are obviously gung-ho about the liquidity injection by the European Central Bank, and these are powerful instruments they deploy. Especially market participants, investors now see there's more room for crisis resolution. What I see is that the politicians are not using that time that the ECB has essentially given them for actually making progress on crisis resolution. So we see no progress at all on the most important issue of all, which is bank resolution. Establishing banking supervision systems, bank resolution systems, bank deposit insurance system. None of this is happening. There's no progress at all on this matter, and that means that, in my view, the crisis is likely to go on, flare up again, and will be with us for quite some time to come.
Spain seems to be the latest victim of the European debt crisis. What's the biggest danger to the country's economic survival?
The problem with Spain is that it is a large country. Portugal and Greece are both very, very small countries by comparison to Spain. Spain is better off than the two countries. I'm not putting them in the same basket. The problem in Spain is that the private sector has very, very high debts. The government is relatively okay, but the private sector, especially the banks, have extremely high debts that need to be deleveraged. And we're in this process of deleveraging, which will take about 5 to 10 years. The problem we're seeing in Europe is that the government cannot compensate for that. Normally, a government, as in Japan, as happened in Japan in the 90s, would increase its own debt to help the private sector to reduce its. In the Eurozone, both the public sector and the private sector have to do it at the same time due to the rules of the Eurozone. And that means that we're going into some kind of debt spiral, some debt trap that Spain might end up. That is my greatest concern for the Eurozone right now.
What would the right adjustment policy there look like?
The right adjustment policy for Spain would be to keep a relatively large fiscal deficit in place for a number of years. And by large, I don't mean 10%. I'm meaning something like 5 to 6%. While the private sector deleverages, while one forces the private sector to deleverage. So one should force the banks to write off the bad property loans so that this thing gets over. Now, house price will have to fall further. There will be a number of rough years ahead. And there's nothing avoiding that. But at least if the government maintains the deficit, it can compensate for that problem. And then, only after that process is complete, should the Spanish government start to deleverage. But not to do both at the same time, that is, in my view, a big mistake.
Due to its size, doesn't Italy present a greater threat to the Eurozone?
Yes or no. Italy has a higher level of public debt, but Italy has two things which make it sort of more comfortable than Spain. Italy has a very low level of private sector debt, and it is a very rich country. So, Italy has the classic government debt problem, which you can solve through structural reforms or fiscal reforms. You just have austerity and ensure that the country grows at the same time. I'm not saying it's easy, but it's easier than in Spain. There is at least a theoretical path that would suggest that Italy could resolve its problems.
Thanks, Wolfgang.
Thank you.
Stay tuned to AIC TV for more insights from thought leaders.